mind, looking for a dime. James Locke in the house, gonna help you shine.
Hello everyone, welcome back to the Poole Locke YouTube channel. I'm James Locke, and today we're going to keep going, answer some more of the Ask James questions of the day. First question is from Amy. She says, what if we plan to buy an RV in retirement and we plan to finance it? How will that affect my risk tolerance decisions? All right, Amy, well, first of all, I want to start off by saying I'm not a big fan of financing lump sum purchases in retirement. I'm really not. Going in with cash is really a big benefit. In fact, I've told stories in the past, many times about a client of mine who kind of taught me the importance of paying for cash, especially for cars and things like that. But the one time you might want to consider financing, and I believe you shouldn't finance it because if you don't have enough money, right? You should only finance it if you don't have the money to buy this. Well, if you don't have the money, then you shouldn't own it, right? But if you have enough money to buy it, but financing makes more sense than paying cash, well then, we can look at that. So one example, what if you have a lot of money in your 401k, and you're lopsided towards that pre-tax account. So if you pulled out a few $100,000 to buy an RV, you're going to have to pay tax on it all, and it's going to cost you a lot more money. That's a great situation where you've got the money, but there's this tax lien on it. So you might finance the RV and then just take out installments, right? Now from the interest and dividends from the IRA and the 401k to pay the taxes to pay off the note, right? And in some cases, in the case of the RV, it could be considered a second home. The interest could be deductible, which means now you're taking more money out of your 401k and IRA, paying taxes on it, but then you have a deduction to offset that. So it could work. The other thing is that if you have enough money, but yet you have a drop in the markets, and now you say, okay, I want to finance it just because I don't want to sell right now. I have enough money, but I don't want to sell when the markets are down. Okay, well then you're not financing because you need the loan to buy the RV in your case. You're taking the loan because you don't want to sell the asset when it's down to buy the RV. And that might be a good time to finance it, right? I mean, if the markets are down, usually we're in a bad economy, a recession, it means that's when interest rates are lower. And that also means that you could probably lock in some good low interest rates and finance rates at that time. Now, regarding how this affects your risk tolerance decisions, it's important to consider the impact on your overall retirement income strategy. If you decide to finance the RV, you'll need to factor in the monthly payments as part of your ongoing expense. This means you'll need to ensure your income-generating investments can cover not only your basic living expenses, but also this additional obligation. You might want to consider allocating a portion of your portfolio to more stable income-producing investments to cover these payments. This could include high-quality bonds, dividend-paying stocks, maybe a ladder of CDs that mature in sync with the payment schedule, annuity payments is all different options. Remember, taking on debt in retirement does not increase your overall financial risk. You're committing to future payments, which means you need more, certainty in your income stream. So this might lead you to favor a more conservative investment approach for at least a portion of your portfolio. Now, on the flip side, if you decide to pay cash for the RV, you might have more flexibility in your investment choices. Without the ongoing payment obligation, you could potentially afford to take on a bit more risk with your investments, aiming for higher returns to replenish the funds that you use to purchase the RV. So ultimately, the decision to finance or pay cash and how it affects your risk tolerance should be made in the context of your overall financial picture. Consider factors like your total retirement savings, your expected income from various sources, so Social Security, pensions, things like that. your other debts and obligations, and your overall retirement goals. Amy, I kind of hope this clarifies a bit when and when not to finance and how this decision can impact your retirement strategy and risk tolerance in retirement. Remember, the key is to maintain a balanced approach that provides the income you need while also allowing for some growth to keep up with inflation over the long term. That was a great question. Good luck with the RV. As always, if you'd like to send in your question, you can do so by emailing them to poollocke@poollocke.com. Moving right on, we have our second question. And this comes from Beverly. She asks, I tend to be more risk averse, more conservative. Meanwhile, my husband likes to take a lot of risk. So how do we compromise? All right, Beverly, so yeah. First off, you are not alone, right? This is a conversation I hear on a regular basis. So let's break it down. Let's talk about lump sum goals. You want to redo the kitchen in the house, and your husband wants a small fishing boat. Well, then, you should be more conservative on how you invest for your goals. And he can be a little more aggressive for how he invests in his lump sum goals, right? Because he's willing to take more risk, which means if he doesn't get it, maybe he's okay with that, right? So that's part of it. The second answer is you have to compromise. Marriage is all about compromise. And Beverly, I don't know how long you've been married, but I know many people that have been married many years, and I know that it's always about compromise in marriages that last, right? So you have to kind of meet in the middle. So for a lot of people, the person who's more aggressive needs to kick it down a notch and become more conservative. And the person who's more conservative, in many cases, is worried that the person doesn't understand and maybe needs to be a little more informed. So part of it is compromise. And the same thing is true with your risk for your investments. Now, when it comes to retirement, what people do, not everyone, but some people do, Beverly, is they say, okay, let's take my I need goals and let's have lower risk to achieve the I need goals. And then let's take the difference between the I need and the I want and take more risk there. And that way, if you have losses before retirement because of your husband's propensity to take risk, it doesn't cut to the bone, right? You still can cover your I need goals. It might just take away a little bit from some of the things that you want to do down the line. Now, when it comes to investing for income and retirement, this compromise approach can be particularly effective. For your I need goals, you might focus on more stable income-producing investments. Because high-quality bonds, dividend-paying stocks, from well-established companies, or even annuities for a guaranteed income stream. These investments tend to be less volatile and can provide a steady income to cover your essential expenses. For the I want portion of your portfolio, where your husband's higher risk tolerance comes into play, you can consider a mix of growth and income investments. This might include dividend growth stocks, real estate investment trusts, or even some high yield bonds. These investments have the potential for higher returns, but also come with more risk. Another strategy to consider is the bucket approach. You could have 3 buckets, a short-term bucket with a very conservative investments for immediate needs, a medium-term bucket with a balanced approach, and a long-term bucket with more aggressive investments. This way, you're addressing both of your risk tolerances while ensuring you have the income you need throughout retirement. So it's also worth considering that your risk tolerances might change over time. As you get closer to and move throughout retirement, you might both become more conservative. Regular check-ins and portfolio rebalancing can help ensure your investment strategy continues to meet both of your needs. Lastly, do not underestimate the value of education. The more you both understand about investing and risk, the easier it will be to find common ground. Now consider attending financial workshops together. or meeting with a financial advisor who can help explain different investment strategies and their potential outcomes. Beverly, I really hope these words have helped you in some way, shape, or form. Remember, the goal is to find a balance that allows you to meet your retirement needs while also giving you both peace of mind. Great question, as always. Thanks so much. If you have a question that you would like answered, go ahead, shoot it in, email it to poollocke@poollocke.com. If you like what you heard, go ahead, like and subscribe to the channel. I'm James Locke, your retirement income source. See you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear.